Hello, my name is Doug Greenberg, President of Pinnacle Wealth Advisory, and this is an update on the election and the recent sell off. To summarize the four election scenarios, let's break it down. The first and most likely scenario currently, with a 45% probability, sees Vice President Kamala Harris becoming the next president of the United States. In this scenario, we anticipate a divided Congress where Democrats regain control of the House and Republicans take the Senate. This scenario represents a continuation of the current status quo, meaning that significant shifts in economic policy are unlikely. The second scenario, which we attach a 35% probability to, envisions a Republican sweep, leading to more substantial changes in policy and significant economic consequences. The third scenario, with a 15% probability, suggests that former President Donald Trump returns the presidency with a divided Congress similar to the first scenario. Lastly, the fourth scenario, considered a tail risk with only a 5% probability, sees the Democrats sweeping the election, gaining control of both the presidency and Congress. When you add up the probabilities, the chance of either Harris or Trump winning the presidency is split 50-50, indicating a very close race. The policy implications of these scenarios are varied and significant, particularly in the areas such as trade tariffs, immigration, and tax policy. For instance, a Trump presidency would likely see broad based tariff increases, including a 10% across the board tariff and potentially a 60% tariff on Chinese imports. In contrast, a Harris presidency would likely continue President Biden's more targeted approach to tariffs. On immigration, both Harris and Trump would focus on securing the border, but their approaches to deportations would differ significantly, with Trump advocating for the deportation of unauthorized immigrants on a large scale. Lastly, tax policy would also see major differences, particularly concerning the expiration of individual tax cuts under the Tax Cuts and Jobs Act of 2017, which Trump passed during his presidency. These scenarios paint a picture of the potential economic and political landscape of the United States, depending on the outcome of the election, and underscore the importance of closely monitoring these developments. So, looking through the election ahead to next year, there's a significant likelihood that we'll be facing another intense battle over the debt limit. The previous suspension of the debt limit expires on January 1, 2025. And by this time next year, the Treasury could be running out of cash, necessitating action from lawmakers. When considering the election scenarios, there's a 60% chance of a divided government, which heightens the risk of a contentious debt limit standoff. Historically, these battles have grown increasingly fraught, and each new confrontation feels more unnerving than the last. This is partly because we've become somewhat desensitized to the process, assuming that, in the end, lawmakers will come together and avoid breaching the debt limit. However, this complacency might lead to inaction, increasing the odds that the limit is breached, which would have significant macroeconomic consequences. The current baseline scenario assumes the debt limit will be raised in a timely manner, but this remains a key risk. Moreover, our broader financial trajectory is concerning. The ratio of publicly traded federal debt to GDP is currently around 100%. And without changes to policy, this ratio is projected to increase dramatically over the next 30 years, according to Congressional Budget Office, the CBO. This outlook is based on relatively optimistic assumptions about the economy and interest rates. As debt continues to rise, the impact on long term interest rates will become increasingly severe, potentially leading to a crisis in the bond market. Interest rates could spike, and this could be a catalyst needed to generate the political will to address our fiscal challenges. The scenario is unsustainable, and while a crisis may not be imminent, the risk looms larger with each passing year. It's a situation that demands attention, as the consequences of inaction could be severe for the economy. This is a crucial issue that will likely come into sharper focus as we approach the end of the debt limit suspension and beyond. The recent employment situation report has raised concerns as it fell short of expectations, showing a noticeable slowdown in job growth and a sharp rise in the unemployment rate to 4.3%. the down, and then the up. This uptick in unemployment is significant, reflecting a broader trend we've seen been developing over the past 12 to 18 months. The overall labor market is weakening, with key indicators like non-farm payrolls and aggregate weekly hours trending down. This is the effects of high interest rates to reduce inflation to slow the economy. The Coincident Employment Index, which aggregates several important labor metrics, has also shown a decline, signaling potential economic challenges ahead. This index has been below trend since 2023 and has now slipped into fractional contraction, which is a worrying sign given its historical accuracy in predicting recessions. The weakening of the labor market is further highlighted by job losses in highly cyclical industries like manufacturing and trucking, though some sectors, such as residential construction, have remained relatively stable. As labor demand begins to fall below labor supply, we're likely to see less wage pressure, which could ease inflation, but also signals a cooling economy. The Federal Reserve may need to consider adjusting its policy rate to a neutral level to stabilize these labor market trends and prevent further economic slowdown. Given the recent economic developments, Goldman adjusted their outlook on recession risk, raising the 12-month probability by 10 percentage points to 25%. Although this increase suggests a higher risk than the historical average, I still believe the chances of a recession at this point remain limited. This is because overall, the economic data doesn't show significant weakness and there are no major financial imbalances at play. Additionally, the Federal Reserve has substantial room to maneuver, with 525 basis points available to cut interest rates, if needed, to support the economy. In response to recent labor market data, we've updated our forecast to anticipate 3 consecutive 25 basis point cuts starting in September, rather than quarterly cuts as we previously expected. This adjustment reflects the view that the current federal funds rate is too high and that more immediate action may be necessary to bolster the economy. However, if the August employment report shows continued weakness, a larger 50 basis point rate cut could be on the table for September. The Fed's flexibility in this situation is crucial, and its readiness to adjust rates should help mitigate any downside risks to the economy. The recent stock market sell-off was sparked by fears that the Federal Reserve may have missed its chance to support a slowing economy. After the Fed decided to keep interest rates steady, signaling potential rate cuts in September, major indices like the Nasdaq 100 and the S&P 500 saw significant drops, with technology and consumer discretionary stocks hit the hardest. However, sectors like utilities and real estate, known for paying high dividends, actually performed well as investors shifted their focus towards these safer, income-generating options amid falling bond yields. This marks the second rotation in the stock market in recent months. Previously, small cap stocks gained attention due to narrowing valuation gaps with larger companies, but as the gap widened again, investors returned to large caps. Now, with the possibility of rate cuts looming, investors are gravitating towards lower volatility, dividend-paying stocks while avoiding riskier small cap stocks. This shift comes as market volatility increases, with key indicators like the VIX rising to levels not seen since early 2023. Despite the sell-off, there's still a sense of caution rather than panic, as many believe the market is simply adjusting from an overly exuberant rally. Some investors are hedging against potential declines, but overall, the market seems to be recalibrating rather than entering a crisis mode. In looking back over the last 9 trading days from July 19th to August 1st, and looking at the model performance versus the S&P, not from a construction point of view, but just from a return perspective, we can see that the models are holding up really well in compared to the downturn in the S&P. Please let me know if you have any questions, and I hope you have a good rest of the day. Thank you.